It's time for the Your Personal Bank Show with Ferenc Toth, president and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome to Your Personal Bank Show, and I've got a fun one today. By the way, some of the listeners, it's been great getting the information, contact with you guys, and reaching out to me, and guys and gals, I should say, and asking some questions and whatnot, and it really helps me in knowing what to share. So awesome, thank you, keep it up. I got one that particularly comes to mind that I thought was really interesting. So I get Facebook send this article, or actually it was a video that this, I won't say the name because I don't want to embarrass anybody, but, this high-powered financial advisor, he's been on various media, TV, radio, all this kind of stuff. And he was sharing, it was kind of interesting. He was sharing, well, now I'm teaching people, to put away 12 months of their income or 12 months of their expenses in an emergency account. And I was asked, this listener, friend of mine, asked me what I thought my opinion of all this. And he went on and talked about how the things that you could do to cut back on expenses and negotiate with a credit card or other debt that you may have, and all these kinds of things to build that emergency nest egg. And a lot of the folks listening to Money Radio, of course, already know this. You have to have an emergency nest egg. My thought was, the first thought I thought to myself was, now you're teaching people that? That's like financial planning 101. How many times have we heard you should have 6 to 12 months of emergency funds set aside for emergencies? And clear as he went on, and he was about a 10-minute thing he did, video thing. He's talking about, he's really focused on growth. Everything was all about growth. And as I listened to him further, I'm going to guess probably early 30s, guess age-wise, young, ambitious, very personable guy. I liked him. I liked what he had to share. And by the way, I want to say is, welcome to the club. We've been talking about this for years. If you went to any of my workshops or listened to any of my presentations before, you've known, and some of them are recorded. I've been talking about this for years. And I think any financial counselor, advisor of anything of any sort worth their salt should bring that up, and I'm going to say shame on you if you don't, because that is probably, like I said, that's financial planning 101. And the other thing I want to say about that is, this is Your Personal Bank Show. I like to point out opportunities. I'm also a banker. I'm the chairman of the board of a bank in formation, so I'm very familiar, I've got a lot of information and knowledge on the banking industry. Most people take that emergency fund and they put it in a money market type of account. Okay, savings, money market in the bank. Now, nobody said you had to put it in the bank. These days, what's the interest rates on those types of accounts? We all know very, very low. Your personal bank, a portion of those emergency funds could go there, and why not get credited 5% on the money and have some safety, some guarantees, and some tax benefits involved. And it's easily accessible within a day or two. Okay? So my point is, you can actually have some of your emergency funds still working for you. That's one of the things we talk about a lot with folks. And it's a great place to start, by the way, where a lot of our clients actually start because they're thinking, wait a minute, I'm tired of getting next to no returns on those emergency monies that I know I need in case of emergency. Why not allocate some of those dollars and actually let them earn something? That's kind of the side point. Back to this thing, this interview or whatever he was talking about, I just thought it was interesting. It's like, again, welcome to the club. I'm glad he's starting to share some of those things. And as I'm listening to this and looking at his age and experience and what he was sharing, it brought me to that point of, I remember when I was younger, and I didn't like getting told this. I think most of us that have a few years on us, not that I'm old, but we'll just put it that way, have had a few years or decade or two of experience or more. Remember when we were young, we thought we knew it all. And, the arrogance of youth is kind of funny. And we didn't want to get told by other people that we should do some of these things. But over time, we come to learn that there's some wisdom in that. And I realized, he's come to some newfound wisdom due to this economic crisis. And, hey, good for him and congratulations. But it wasn't there before because he probably wasn't in the financial industry during 08, 09 advising people. Probably hadn't had any experience with himself. Probably was in high school or college at that point himself. so had little or no experience with what it's like to be in a downturn. And the thing is, we're human beings, we're creatures of habit. It's amazing how that comfort zone or that habit or how easily we get used to a certain situation or the way it is. And we had an unprecedented, historically long bull market over a decade. And it's easy to get used to that. And a lot of people did. And even those that maybe should have even known better got away from the things that we knew all along worked. Having that emergency fund, for example. Just because things have been good for a while doesn't mean they're going to be good all the time, okay? I'm an optimist. Hey, I would love it if that's how things went. It would be great. But it's not realistic, okay? And that's the thing to understand is having that balance of growth and safety is really the key for long-term success. Modern portfolio theory teaches that all the time, and there's study after study showing that over a period of time, that balance is what really makes things work. And what I love about the personal bank tool is it fits that safer option of that balance really well for a lot of people. And it allows for some things that maybe some other accounts don't allow for and provide some opportunity for folks. And the thing is, what I teach people, I'm going to go into a little bit about, I haven't talked a lot about how your personal bank works recently because it's all this financial crisis with coronavirus and all this stuff. It's kind of dominated the news, if you know what I'm trying to say. I want to go back to that a little bit. For those of you that have heard this before, I got a few new thoughts here, maybe you have a different perspective now than you did a few months ago. So it might be good to hear this again. And those of you who haven't, I'm going to share some things about how your personal bank really works. And when I talk about that, I always say to people, look, before I teach you how your personal bank works, I've got to teach you one key financial literacy concept. And that key is you have to learn how to think like a banker versus an investor. Now, a lot of people are investors and they think, wait a minute, what do you mean by that? Well, I'm going to explain. Basically, as we all know, most investors trade hard-earned dollars for assets with the expectation the asset will increase in value, right? I mean, that's the purpose. Now, what I find is, and you know what I'm talking about, whenever I talk to somebody who's excited about an investment, what do they inevitably bring up? They talk about how much they made or what percentage, right? In other words, the focus, I find, in most cases, is overwhelmingly on the potential gains. Now, granted, that's very important. That's why one of the main reasons why you're doing that. But there are other factors also that often get overlooked. In other words, what's the cash flow situation? Does this particular investment create a cash flow? Why is that so important? Well, in our lifetime, what do we typically need more of? Do we need appreciation or do we need cash flow? We actually need both. The thing is, throughout our life, as we're going through our working lifetime, if things go wrong, the roof leaks, the car breaks down, we need money. We need cash flow. If we lose our job or business income, like a lot of people have experienced recently, we need cash flow. We need income. Appreciation doesn't do us so much, benefit us as much. And during crisis times, that growth asset may have taken a hit, and now you take it at a time where it's in a down. So having some other monies in another bucket, if you will, growing consistently is so important, particularly when crisis occurs, whether it's an economic crisis or a personal crisis. We're going to talk more about this in the next segment about how to think like a banker versus an investor. Stay tuned.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to Your Personal Bank Show. We've been talking about today with the unprecedented uncertainty with the current crisis we've been in. Time to take a look at reallocating some of those monies, some of those funds to create some certainty, create some guarantees, create some consistency and growth of your money. That second bucket of the three-bucket principle, the emergency bucket, the ongoing income, interest-bearing, or cash flow bucket, and then the growth bucket. And in the first segment, I was talking about a younger, I would say less experienced financial advisor who's very passionate and has a great message, has just come to the conclusion recently that he's sharing with his clients to put a year's 12 months of expenses in a emergency bucket of monies, which I think is kind of humorous because should have been doing that all along, right? My point is, we get you away from that stuff. We get used to things the way they are, growth, the over-focus. And again, I've been doing this my 23rd year. And more as I saw through this last decade or so of this bull market that we were in until recently, the focus became more and more hyper-focused on growth. And a lot of people got out of whack in their balance because, well, it just kept working, right? And we're creatures of habit. We get used to certain things, that comfort zone. And it's funny how that impacts people, and you get comfortable in that realm until all of a sudden things change, which they have dramatically, of course. And that's when that discipline of having that balance comes back and is so important. So having that emergency fund, I also mentioned, having that emergency fund, now, of course, is important, but nobody said you had to keep it in the bank in a money market or savings account earning next to no interest. The criteria is simple: safe and liquid. If you find a place where you can put it where it's safe and liquid and get a decent interest rate, why not? Your personal bank fits that criteria. That's where a lot of our clients, by the way, typically start with the personal bank concept because they're thinking, wait a minute, I know I need the emergency fund, but if I can get a better return on it, gosh, why not? And it's liquid and it's safe. It fits the criteria. So again, if you haven't considered or looked into the personal bank tool, start there. Contact us at yourpersonalbank.com. We'll show you how that works and get a better return on your safe money and your emergency fund that you should have, as we all know. And we can also expand that further if you want into that middle cash flow income interest earning bucket if you like. But anyway, as I said, that new younger financial advisor who is very passionate, welcome to the club, by the way. Now, how does your personal bank work if you're going to use it for that some of that emergency funds or that middle bucket of safer cash flow interest-bearing funds? Well, as I stated earlier, you have to learn how to think like a banker versus an investor. And what most investors do, what's the difference? It's quite simple. Investors typically trade hard-earned dollars for assets with the expectation the asset will increase in value, focus on the potential gains only, create little or no cash flow in most cases, right? And rarely ask, what's my recourse if things go wrong? They don't think about the downside. What's the plan B, right? And here's the thing. I always say, look, if you purchase an asset, whether it's a stock, a piece of real estate, a business, I don't care what the asset is, can you tell me what it's going to be worth in a year? In normal times, you can't tell. You can predict, you can look at charts, but you don't really know. Right now, with the unprecedented level of uncertainty, it's more uncertain than ever. Just don't know, right? And this is not from me. This is from many, many sources. Primarily investing for appreciation is just another form of gambling. It involves risk. Now, some people are comfortable with that risk. I understand that. But studies after studies show the majority of folks, somewhere like upwards of 80% of the average human being, is not comfortable with that level of risk. And what I find, personal experience working with folks, is they're often much higher risk than what they're truly comfortable at. So we help them reallocate. And we have that different discussion that many times they've never had before because all they've ever looked at or been told by media and other sources is, risk, reward. And they're looking for another alternative and just haven't found it yet until we meet. And that's why we talk about that. We do other things too, but that's why we discuss that. Now, for that person who wants or is comfortable with risk, we have tools for those. We have leveraged options and we have tools that, optimized type tools that can, based on indexing, there's some downside protections involved, but have the higher potential growth rates. We have those tools, okay? I focus on the safer option primarily because the vast majority of the folks I talk to, that's what they're really looking for. When it really boils down to it, that's what they're looking for, and that's what they want, and that's what they thank me and appreciate when we have those discussions and help them move into that where they are more comfortable, where their comfort zone really is, and their life gets better because their financial stress gets reduced. Again, if you're not one of those people, fine. I'll show you how to do some more of the aggressive options, if you will. That's great. But again, let's figure out what fits you first, okay? Now, as we go on to this, bottom line, I know we got a sidetrack bit, but I thought that was important to share. How does a banker operate? How does a banker think? Well, bankers are risk adverse by nature, okay? Bankers also are savvy when it comes to money. They're very successful in that arena. I think it's hard to argue. But how does a banker think? It's really quite simple. Most of us have taken a mortgage or a car loan at some point in our lives, right? And when we signed papers for that loan, we knew we would have a payment, right? I always asked, do you plan to make the payments? Of course you did. You wouldn't have signed the papers otherwise, right? And if you had not, and by the way, you went through a whole approval process just to get the loan in the first place. So guess what? You're pretty certain you're going to make those payments, right? So is the lender, so is the banker. Because again, you went through an approval process. And by the way, in the off chance you didn't make those payments, what would have happened? Well, ultimately, they would have taken that house or the car, right? And they would have resold that asset to somebody else to create payments from them. And so when you think about it that way, you've got to ask the question, is the banker really risking their money? And the answer is, in the overwhelming majority of cases, when it comes to collateralized loans, that's where the asset you borrow, they can repossess or foreclose or whatever. The answer is no. It's very rare that a collateralized loan ultimately becomes a negative on the balance sheet for a lender. It might be temporarily in the process, but in the long run, it's very rare. Again, they're going to get payments from you, which is, by the way, cash flow, which is what most of us need financially throughout every stage of our life, including retirement and prior. But they get cash flow. And they've protected their downside, the collateral, the protection, right? And that's the criteria for a good investment for a banker: secure cash flow and collateral downside protection. So that's why we discuss the personal bank, because really it's a financial tool. We use the term personal bank more as it's a marketing term, granted, but it's really more of a descriptive term. And I thought of this because I wanted to describe how this tool is used rather than the name of the tool that most people are familiar with, because I felt like if you made a better description, it would help people better understand. So, again, what's the first thing we all do with a check when we get it? Well, we dump it in the bank. We deposit in the bank, right? And what do? They loan it out, compound interest. The thing is, they're creating cash flow on the money that we give them. So can you. In fact, what do banks really do? Well, it's really quite simple. Most people don't know this. And I always say, look, assume you walked into a bank and you opened an account. Then the next person walked in and they qualified and got a car loan. Does the banker take the cash you just gave them and turn around and give it to the car loan person? Stay tuned to the next segment. I'll answer that question. Because when I asked that question, I've been asking it for years. Individuals, groups of investors, I'll have 100 people in the room who are savvy investors. And fully 80% of the time, based on the experience I've had for the last several years, they get this answer wrong. Stay tuned to the next segment, and I will give you the answer on how a bank operates and then teach you how to do the same.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. We are talking today about how to think like a banker versus an investor. Now, why is that important? Well, in this unprecedented time with this financial crisis we're dealing with, the reality is no one really knows what's going to happen. Last week I talked about this is like Dorothy in The Wizard of Oz, who got sucked up in the tornado and had no idea where the house was going to land. And I think that's a great analogy of where we're at right now. No one really knows ultimately how all this financial crisis is going to result. What's going to be the short, medium, long-term results? We just don't know. It's that unprecedented uncertainty that creates a cause for needing to create some certainty with your money. protect some of the monies and give it some guarantees and some consistency. Okay, and that's why discussing your personal bank is a great tool to accomplish those things. And like my compliance folks always like to say, it's not for everybody. I understand that, but you certainly should take a look at it, particularly in these times, because this is different. I talked about last week where Harvard economic professors, well known, talked about how this time really is different. This is unprecedented, and it's uncertainty. So in the last segment, I was just talking about thinking like a banker versus an investor. And I was talking about the differences of how that works. And the thing is, you can like banks or hate them, don't really care. But I think we can agree the banks are savvy about money. And certainly we can learn from them. And as I was stating in the last segments, what do most investors do? They typically trade hard-earned dollars for assets with the expectation the asset will increase in value, right? They really don't know what the asset is going to be worth in a year or 2, 5 from now. You're hoping that it goes up, but if it doesn't, well, what's the downside? Well, in most cases, people just lose money. Bankers are risk averse. They're not interested in losing money. They're interested in creating cash flow. So what do? When you take a loan from a lender, they're charge you interest. You're paying them a monthly payment, basically, right? In most cases. So that's cash flow that's coming to them. And if you don't pay them, they're going to take the asset, if it's a collateralized asset, like a car or house, for example, and sell it to somebody else and create income from them. That's a criteria for a good investment for a banker. So if you're going to operate like a banker, you got to understand how banks operate. And as I teased in the last segment, I'm going to teach you how banks really operate. And understand, I'm the chairman of the board of a bank in formation. I'm in the process of helping start a bank, an FDIC-insured bank. I have a little credibility in this area. Been dealing with this, teaching this for years, but now actually have some experience in this area. Here's what I want you to understand. When we get a check, what's the first thing I'll do with it? We deposit the check. What does the bank do with our deposit? They loan it out for cars, houses, credit cards, all that kind of stuff. See, you want to do what banks really do. And as I started to say, let's say you walk in a bank and you open an account. The next person walks in the bank and they qualify for a car loan. Does the banker take the cash you just gave them and turn around and give it to the car loan person? See, I ask this question all the time, and fully 80% of the time, this is an informal survey, but based on several years of sharing this question, 80% of the time, folks get it wrong. Actually, the answer is no, they do not. What the bank does is they actually take the cash you just gave them and they stick it in the safe. And then they loan it, they borrow against the cash they hold to make more interest. And guess what? The bottom line is you can do the same thing. And the thing is, can you borrow against an asset? That's the point you got to understand. Well, yes, we do it all the time with cars, houses, credit cards, all that kind of stuff, right? So you want to do what the banks really do. Banks don't invest in the stock market. I'm talking about FDIC-insured banks, okay? I'm not talking about Goldman Sachs and those types of investment banks. Those are really just, they deal with Wall Street and that. They're bank in name only, really, what they do. They invest in the markets. What a bank does, a true bank does, typical traditional bank we're all familiar with, is they earn compound interest on our deposits. That's their primary source of revenue, okay? And then they borrow against the cash they hold to earn more interest. Well, so can you. What personal bank does, and again, it's a descriptive term. It's a marketing term, yes, but it's really more, we thought of it more as a descriptive term to help you understand how this tool really works. You're creating an asset that has guarantees, okay, downside protection, that type of stuff, so it's not going to lose value. You want access to capital day one. That's important to a majority of the funds. You can earn interest on the asset and the borrowed funds, and you want tax-favored growth and access, okay? And there's a positive arbitrage potential actually too, which is really cool. Now, the financial tool we use is a specific type of insurance with specific riders. Now, here's the challenge I run into, and I ran into this just this last week. When I state insurance, some people immediately think, oh, great, the last thing I want is another bill. They think of it as an expense, not an asset. Stop listening and miss the whole point. In fact, I had a gentleman last week who I was sharing this idea with. He talked to some of his colleagues other investors, and they gave, oh, that's insurance. You don't want to do that. But to his credit, he talked to me further because he was intrigued. He'd heard from the radio show enough information, and he went to our website, yourpersonalbank.com, and looked up some enough information that he was intrigued into looking further. We had a discussion. We met for a while, and he's an engineer. He was asking a lot of questions, naturally inquisitive, which he apologized a couple of times for asking so many questions. And I said to him, look, I understand you're asking good questions. And you're asking questions with the intent of understanding. I'm fine with that. In fact, I encourage that. Well, after a little while, you realize, you know what? This isn't at all what my friends were telling me or my colleagues. This is something totally different. I said, exactly. And I pointed out to him one of my biggest challenges is people who have preconceived notions who just won't listen. You know, I find my experience, some of the truly wealthy folks that I've gotten the pleasure and chance to work with, overwhelming majority of them are very naturally inquisitive. In other words, they're always learning. They're actively learning, wanting to learn more. I find that quite interesting. And then other people who I meet, most people are cool and they'll listen, but there's some that are just, I think the analogy is it's like concrete. Their minds are all mixed and set. It's all mixed up and set. And doesn't matter what you say or do, they're just not going to listen. In general, I find those people are moderately, can be moderately successful, but I find that they're not as successful in their lives as many of the folks who are always learning, the learners. Learning more information and learning new information and not having a preconceived notion about something can really go far, take you far in life. So if you've had this perception or somebody said to you, oh, that's insurance, you don't want to go there. Well, that just shares what you're listening to is somebody's personal preference or prejudice. It's just like when somebody says, this product is good or that product's bad. When they make these categorical statements, these blanket statements, here's the thing. Every financial tool that exists out there has a purpose, okay? And for some people, it's a great fit, and for others, it might not be. But just to state categorically that this is great or that's bad is just sharing your personal bias. It's like saying a saw is great and a hammer is bad to a carpenter. Well, they're not to a carpenter. There's a great tool for one job, and the other's a great tool for another job. What's the purpose of this money? And by the way, should all of your money be allocated in one arena for one purpose? I'd say the answer in most cases would be no. No, you should have a balance of funds or balance of buckets of money that have different purposes for the long term. That's what most people are at for long-term retirement success, right? If you're talking to someone who's focused on managing money, that's their goal, that's their job. They have one purpose: grow the money, right? They're not retirement planning. They're not doing the whole picture. You see what I'm trying to say? We're going to touch on this more in the next segment on understanding how this can be an asset. And I'll talk about the teeter-totter where we're maximizing cash and minimizing death benefit with an insurance tool, which is completely the opposite of what most people use it for or are familiar with. Stay tuned.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
All right, we're rounding third, wrapping this up. But I just want to share, we've been talking a lot about, with these unprecedented times, uncertainty on not knowing what's really going to happen with the economy. No one really knows, okay? So reallocating some of those funds into a safer option to ensure the money's going to be there, it's going to grow, you'll have access to it, use of those dollars. And then when those opportunities present themselves, that money will be there. You don't have to worry about it. And reduce overall financial stress, I think, is really important, particularly in these days. And we're talking about the personal bank tool and how it works because, again, for many people, it just fits that criteria for what that the emergency bucket we started talking about at the beginning of the show. We all know 6 to 12 months of expenses you should have set aside an emergency bucket. No one told you it had to be just in the bank in a money market savings account. You can actually earn some interest on it, and have access to it, and it be safe. Okay, personal bank tool is a great fit for that. Okay, for some of those monies, and that middle bucket, that cash flow, interest earning cash flow bucket. The personal bank shines in that arena too. There's other tools that do also. We can discuss those, but I find it's a good fit in many cases. Okay, not for everybody, but certainly for many people. Okay, you certainly should look at it. Okay, and really, I'm just touching on how the personal bank works. And like I said, we think like a banker versus an investor. If you missed it, go back to the last segment, or go back to go to yourpersonalbank.com. You can listen anytime to any of the shows. But the reality is, bankers are savvy about money. We want to learn from them. We want to create cash flow. We want to create monies that'll grow consistently on a regular basis with some guarantees. And that's what we're talking about here. That's what it's about. And we primarily use an insurance tool, and very specific type with specific writers. Okay, not just any old tool. And as I stated in the last segment, often I get people miss the boat because they say, insurance, you don't want to do that, or they don't want to listen. They turn off. And, if you don't have a curious mind, you don't learn new things. And realize that what we're doing here is completely the opposite of what most people are familiar with or what they're used to in terms of what insurance does. You can use it to maximize cash growth and minimize the death benefit. That's our goal here in most cases. Why do we use it? We want compound interest. We want money to grow on an increasing basis every year. We don't want risk of loss. We don't want to access. Remember, we're thinking like a banker. We're going to create cash flow. We don't want to, and we want to have use of the money if need be. You don't want to borrow against an asset that could lose value. That's a recipe for disaster. Okay. You want to have access to the funds if you need it. We have typically 50 to 80%, 85% availability day one. Okay. And that increases annually. All right. And we want to have, tax favored growth, access to the money, and pass on to the heirs tax-free typically. So it's a really great tool all around in those terms. Again, we're structuring it to maximize cash growth and availability while minimizing the death benefit. And the reality is, if you think of it in terms of a teeter-totter, I know we're on radio, but if you can give me a second, visualize a teeter-totter. And on one side, you put the cash value of a contract or policy, and the other side, you put the death benefit. And most cases, most insurance, how most people use it, I find, is you want the least amount of premium, the least amount of contribution to create the biggest death benefit. And that's what's called a death benefit protection tool. Now, there's nothing wrong with that tool. Like I said, if somebody says this is bad or that's bad, they're showing their bias. It's just their personal bias. Every financial tool has a purpose. If you have death benefit protection needs, like I do, I have a family, I have a business. I'm the primary breadwinner of our family. I have minor children. There are some death benefit protection needs, clearly, and I have those types of tools in place for those needs. If you have those needs, and I find a lot of people are vastly underinsured who have those needs, those should be addressed. And we can address those in the most cost-effective method possible, okay? But what we're doing primarily with the personal bank tool is, again, think of that teeter-totter. We're going to flip it the other way. We're going to maximize the cash and minimize the death benefit based on the MEC rules, Modified Endowment Contract rules. It's a tax rule that's been around since the 80s. This allows us 50 to 85% of the cash available day one, maximizes cash growth, and minimizes the death benefit up to the limits. Now, one rule of thumb, I've run into this all the time. In fact, I just talked to somebody this last week who said, hey, I heard what you're talking about on the radio. It's great. I ran into a friend of mine, and he shared with me, he gave me an illustration and all this kind of stuff. I'm kind of got to do the same thing. I said, that's great. I'm glad to hear you're thinking in those terms. Based on his situation, it was a good fit. And I said, if you don't mind, let me, send me an illustration. Let's compare. And his cash value on his illustration the first year was 0. Let me share with you a little secret, folks. If you're looking at a policy to maximize cash growth, the personal bank concept, instead of maximizing death benefit, you want to maximize cash. Here, I want you to hear this. If you don't have at least 50% cash available day one, you're looking at the wrong financial tool to maximize cash. Folks, that's a great rule of thumb to use, because what's happening is, again, that teeter-totter, it's structured incorrectly for the goal you're trying to accomplish. It's structured far too heavily towards a death benefit versus cash. That teeter-totter can swing pretty widely either way. Most people don't realize that. So good rule of thumb, if you're looking at this to maximize cash, get the tax-favored benefits, all that other stuff, but you want to grow your cash, you want 50% or more available day one. If not, the tool you're looking at is not structured correctly. Contact us at yourpersonalbank.com, and I'll show you one that'll be dramatically different. I did that with this person here, and the numbers are significantly different. He's looking at easily between 20 and 30% more cash. Well, lots more cash the first year, but even then every year, the rest of his life. That's a big difference. Not every situation is going to be exactly like that. Please understand. But again, use that good rule of thumb, 50% or more day one. That's a good starting point. We can look at further things beyond that, but think of that teeter-totter as at least half my cash available day one or more. And it's about where the majority of your contributions are going. Is your majority of your contributions going to the cash side or the death benefit side? And when I get asked these questions all the time, workshops, individually, everywhere else, and I get death benefit related questions, I ask the person a simple question. You're asking me a death benefit related question, like how much is the cost of insurance and all these other things. I ask them a simple question. It's this: are you wanting to maximize death benefit, or do you want to maximize cash? And when we're talking about the personal bank concept, invariably the answer is, well, I want to maximize cash. Well, then your cost of your death benefit is now minimized, because we're minimizing the death benefit right off the bat, aren't we? See, again, it's completely the opposite in thinking of what most people think of as the traditional use of life insurance. We're doing the opposite. We're doing what many folks have done out there, whether it's professionals, business owners, corporations, banks, you name it, have done for decades in terms of maximizing the cash versus the death benefit. Okay? That's our main goal here. And by accomplishing that, you accomplish a tool that fits the goal we started with in terms of it could be part of your emergency fund. It could be a portion or your bucket that grows income or cash flow, with that safer bucket to get you through this financial crisis. And wherever this house does land, at least a portion of your money will be there, safely be there. You'll know they'll be there. You can use it if you need it, or take advantage of opportunities that are going to present themselves as a result of this crisis, this financial crisis, right? And long term, I can show you options where this can be a growth tool. This can fit in the growth bucket too. It depends on your risk tolerance and where you're at. We can do all of those things. So contact us at yourpersonalbank.com. Be happy to share this with you and how this could be a fit for you. And there's other options, other tools we use too. But let's figure out how to reduce your financial stress, show you how to survive this, thrive through this, and take advantage of opportunities when it's all over.
Listen next week at noon for more information on Your Personal Bank. Contact Ference at 866-515-6280 or online at yourpersonalbank.com.
This show is designed to provide accurate and authoritative information. The presenter and guests on this program do not engage in rendering legal, accounting, or tax advice. Expert advice from a professional involving your specific situation should be sought, if required. Permanent life insurance is a long-term investment. Products, optional features, and riders may have limitations, restrictions, and additional charges and may not be available in all states. Withdrawals beyond principal may be taxable income. Excessive and unpaid loans may cause the policy to lapse. If a policy lapses, unpaid loans are treated as distributions for tax purposes. Replacements may not be suitable for everyone. There may be penalties and surrender charges when replacing coverage. New products may include new surrender charges and contestability period. Policy guarantees are based upon the claims-paying ability of issuing insurance company and do not apply to the investment performance or assets in the underlying variable portfolios. The life insurance and annuity products in this presentation are not FDIC insured, may lose value, and are not bank guaranteed.